50 million people stopped buying it. Not because they ran out of money, not because the economy collapsed, because they chose to stop. And the people running these companies, paying themselves hundreds of millions while their shareholders lost everything, still do not fully understand why. This is the story of how Western luxury died. Not in a crash, not in a scandal, in a quiet, deliberate consumer revolt that the industry's leadership either failed to see coming or chose not to acknowledge until it was too late. And it is the story of what happened to your money while they were looking the other way. LVMH, the largest luxury conglomerate on Earth, parent company of Louis Vuitton, Dior, Moet, Tiffany, Givenchy, and over 70 other brands. For nearly 2 decades, it held the title of Europe's most valuable company. In January 2026, its shares fell 7.9% in a single day, the worst single-day performance in the company's recorded history, after it reported that revenue had declined 1% across the full year of 2025. Its fashion and leather goods division posted organic sales declines for the 3rd consecutive year. Bernard Arnault told investors that 2026 would not be simple. The understatement was remarkable from a man who had spent 2 decades positioning himself as the architect of an industry that was supposed to be recession-proof, aspiration-proof, crisis-proof. The numbers disagreed on every count. Kering told a more brutal story. The parent company of Gucci, Saint Laurent, and Balenciaga reported a 16% revenue decline in the first half of 2025. Net income collapsed 46%. At Gucci alone, the brand that had for a decade been the group's crown jewel, first-half revenue fell 26% and operating income fell 51%. Kering stock had lost more than 40% of its value from its 2023 highs. Burberry lost more than 55% of its market value and was removed from the FTSE 100 for the first time in its history. These were not marginal declines. These were structural collapses happening in public, in real time, across an industry that had spent years telling investors it was uniquely protected from the forces that affected ordinary businesses. Here is where the fraud angle begins. Not fraud in the criminal indictment sense, though the distance between aggressive misrepresentation and fraud is narrower than most investors are told. The fraud is in the story these companies told their shareholders while the foundations were cracking underneath. It is in the gap between what the boardroom saw and what the quarterly communications said. Throughout 2022 and 2023, as the post-pandemic luxury boom showed its first signs of stress, the major luxury groups continued communicating to investors with a confidence their internal data could not have fully supported. The Chinese consumer, who had accounted for an estimated 35 to 40% of global luxury purchases, was slowing. Chinese domestic confidence was deteriorating. The aspirational middle-class buyer, who had driven extraordinary growth, was pulling back. These were not hidden trends. They were visible in foot traffic data, in retail analytics, in consumer confidence surveys every major financial institution publishes. And yet, the major luxury houses continued expanding their store networks, continued raising prices, and continued presenting investors with projections assuming the Chinese consumer would return in volume and at pace. The price increases deserve scrutiny. Between 2019 and 2024, the entry price for a Louis Vuitton Neverfull bag increased from approximately 1,200 euros to over 2,000 euros. The Chanel Classic Flap increased by more than 100% across the same period. These increases were presented to investors as margin expansion, evidence of pricing power and brand strength. What they actually represented was a miscalculation about the elasticity of aspirational luxury demand. The industry raised prices faster than its aspirational customer base could absorb, pricing out the middle-class buyer who had driven the growth while failing to capture the ultra-high net worth customer who had always preferred Hermès. The strategy that looked like genius in 2021 was exposed as a fundamental misread by 2025. Investors absorbed the losses. The executives who authorized the strategy absorbed the bonuses. That asymmetry is the corporate governance story that has gone almost entirely unreported. In 2024, the year LVMH's fashion division posted its first sustained decline in over a decade, Bernard Arnault's compensation remained among the highest in Europe. Kering's senior leadership, presiding over a 46% net income collapse, continued receiving compensation structures designed during the boom years and never adjusted to reflect deteriorating performance. The boards, populated substantially by individuals with long-standing relationships with management, approved these arrangements without challenge. The shareholders, whose capital was being destroyed, were presented with these decisions as fait accompli. The Chinese consumer's departure was not simply economic caution. It was a cultural decision with a specific name. Guochao, National Wave, describes the movement among younger Chinese consumers toward domestic brands expressing Chinese cultural identity, rather than imported European prestige. Brands like Laopu Gold, whose jewelry draws on traditional Chinese craftsmanship, and Songmat, whose leather goods reference Song dynasty aesthetics, have grown explosively into the space Western luxury vacated. Bernard Arnault himself visited a Songmat store and purchased 2 bags. The symbolism was not lost on anyone paying attention. What the luxury industry's leadership has been slower to acknowledge is that Guochao will not reverse when Chinese consumer confidence recovers. It is a structural shift in how a generation relates to luxury itself. The Western luxury proposition was built on aspiration for a specific cultural identity: Parisian elegance, Italian craftsmanship, British heritage. That identity is no longer aspirational for a significant portion of the world's luxury-capable consumers. It is simply foreign. And foreign is not a problem a new creative director or a marketing campaign can solve. The investment implications are still not fully priced in. The S&P Global Luxury Index delivered a 3-year return of just 8.47% against 16.88% for the S&P 500. Yet analyst price targets continue embedding recovery assumptions requiring the Chinese consumer to return at volumes and price points that no longer reflect market reality. The people running these companies understand what is happening. What they have been slower to do is communicate it accurately to the people whose money funds their operations and their compensation. That gap between what the boardrooms know and what the shareholders are told is the oldest story in corporate finance. It does not always meet the legal definition of fraud. It almost always meets the moral one. If your pension fund, your index fund, or your portfolio has exposure to European luxury equities, and most global equity funds do, you have spent 3 years subsidizing an industry whose leadership paid itself generously while your capital declined. The brands in airport terminals around the world are not the evidence of enduring business strength they are presented as. They are the legacy infrastructure of a cultural proposition being renegotiated in real time by the consumers who matter most. The renegotiation is not over, and the people managing your money through it are still being paid as though it is. Follow now. This channel covers how money actually moves, who benefits, and who pays for the decisions made in rooms you are never invited into. Follow so you do not miss what comes next.